Welcome to Peter Lynch's Greatest Lessons, where I'm highlighting my favorite parts of all the books that he's written. This lesson is on the 6 categories of stocks. As always, liking, subscribing, and hitting the bell if you haven't done so already is greatly appreciated. And if you're interested, consider joining with the Market Moves Investing Book Summaries link in the description down below. So what he's saying with the 6 categories is, what's the difference between stocks? What are the advantages or disadvantages of these categories? What are Peter's opinions on these categories? And also, how do you find success with investing in them? Let's watch a short segment on my longer series to explain this lesson. Now we'll get into the 6 categories of stocks, and the first of which is the slow growers, things like electric companies. The slow growers are usually large. Most of the earnings are given to shareholders, so they have some sort of stream of cash flow that goes into the company, and from that company it is given to you. And with slow growers, there's often not much room for growth. Oftentimes the market is saturated and there's only a little bit left to grow into as the years go on when there's more and more people. So finding success with the slow growers. Their evaluations lie with their dividends. Why else would you invest here otherwise? You can get more growth elsewhere. Number 1, how safe is the dividend? And number 2, what rate can they increase the dividend? And number 3, would they ever need to cut the dividend? So as far as Peter's opinion goes on the slow growers, he's not a fan of buying any slow growers at all. It doesn't fit his investment strategy. But if you want to, that's a different story. Maybe you want to build a stable dividend portfolio. Because you are not the same as Peter Lynch, that does not mean that you should not be buying any slow growers. That is just his opinion. The second of Peter Lynch's categories is the stalwarts, companies like Johnson & Johnson, otherwise called the blue chip companies. Typically, these companies are also slow, though not always. It depends on what products and services they're bringing out that appeals to some sort of market they're moving into. So they might be a snail, but this time they're on a skateboard. So just like before, the stalwarts are also large. With stalwarts, they usually pay dividends but continually gain capital appreciation as well. So we have the cash flow from before plus the capital appreciation to look forward to. As far as finding success with the stalwarts, Peter says that it's picking great stalwarts comes down to buying at the right time, when at a discount, such as, is there temporary bad news pushing the price down that won't be actualized in the earnings in the future? Is it uncharacteristically trading at a lower PE relative to past performance? Is that justified or an overreaction to something? Peter's opinion is that he only says he keeps a small percentage of these in his own portfolio. Good to hold in hard times, especially the basic necessity stocks. Usually gives decent returns, but don't expect anything crazy. They're not bad, but they're just not great. Number 3 is the fast growers, such as the newer companies. The ones capable of enormous growth. They usually don't pay dividends. Their money is better used to develop the company. Keep the earnings, it's providing more value to shareholders to do it this way, because if they're making more earnings per share, then that will be reflected in the stock price, giving you the capital appreciation that you're looking for. They do not always go in the fast industries. Peter actually prefers if they don't. Perhaps a new food place competing with McDonald's that is succeeding. Hey, slow down. We don't do that here. And that's exactly why I'll succeed. As far as finding success with the fast growers, number 1 is to use your qualitative edge. Number 2 is being aware of the risks, which can include poor management, being underfinanced, and the ability to be crushed by larger companies, to just name a few of the very obvious risks. And the third point is to look for solid balance sheets and healthy margins compared to others in the same industry. As far as Peter's opinion on the fast growers, he calls it the land of the 10 to 40 baggers. Good stocks for the long term, as long as you're not paying ridiculous PE ratios relative to growth. Pay special attention to their financial condition and pay attention to the debt and how quickly they're going to be able to pay that off realistically. Then there's the cyclicals, the things like the auto industry, the steel, and the chemicals. The ones that regularly have highs and lows. For cyclicals, It's often industry-wide ups and downs, not just individual companies in this area. The timing is everything for the big profits. However, it's extremely difficult to know when's the good time to buy. As far as finding success with the cyclicals, this is largely dependent on using your qualitative edge in this area. Do you work for or with these companies? Do you know why they are suffering? And what would it take to get them out? Your edge is most useful here. If you understand why they're suffering, what it takes to pull them out, then you will be able to determine when you hear news about them making moves to fix those solutions if they're actually going to work. As far as Peter's opinion with cyclicals, he says it's very difficult to do well consistently in this area. Even if you do know things are turning around, it might take a while for the price to change. Only bother with these if you have an edge with them. Then there's the turnarounds, the rock bottom companies, the cyclicals that didn't catch the momentum, the company missing earnings on low profit margins. Turnarounds, these companies are the least related to the general market conditions. They're just trying to pull themselves out of the mud. With turnarounds, these are also the most likely scenarios where investors like you and I can lose the most money in a very quick period of time. Can it even survive its downfall? When will it start turning around? And this is a very dangerous category because they're the most likely to hit $0. As far as finding success with the turnarounds, he says that most of the success will be with evaluating the balance sheet. Just how bad is the debt? Is the debt, with all the principal payments, due soon, or is it far off into the future? So for example, if the principal payments are due within the next 2 years, and these are the years that they're currently having bad earnings, then to make those principal payments, they are likely going to have to sell assets or do something drastic, which is going to be causing a lot of problems. You'll also need a lot of mental conviction, which is very difficult to do. Perhaps you do pick a winner, but it drops 30% more in price. Would you sell or hold on, possibly buying more? Pessimism is at its worst in these situations. You're never going to hear really good stories when things are looking bad for these companies, so it's going to be really difficult to stay strong. As far as turnarounds, with Peter's opinion, he says this is a super dangerous area and to only invest what you're totally willing to lose. Certainly, this can give high rewards. He did it with Chrysler, which was a poorly managed cyclical situation that ended up turning out alright. He says to be very cautious and pay special attention to the debt obligations and those principal payments. Then number 6 is the asset plays, the unrealized gems. These are companies with valuable assets that people haven't properly accounted for. So for an example of these asset plays, in the book it was listed with Pebble Beach, the real estate company. The whole company was valued at $25 million. 20th Century Fox buys them for about $72 million. Then 20th Century Fox sells just their gravel pit, let alone all the other assets that this company owned, for $30 million a day later after acquiring the company. This company was valued at $25 million with a $30 million asset sitting right under them the whole time. So it's like, I'll sell you this $20 bill for $10 if you want it. And you say deal, because that just seems super obvious. For finding success with asset plays, it takes a lot of searching, expertise, and patience to win in this category. Searching means finding favorably mispriced assets, which is not easy. Usually, management wants to bolster their numbers, not lower them. And expertise. Do you know how to price the assets better than other people? Possibly from using your edge in whatever industry you're working with, where you have the knowledge to do so. And also, it takes patience, because you need to understand that it might take a while for management, the market, or another large company to realize what you see. So for example, with 20th Century Fox, even if you saw that that was a huge asset that they were sitting on, it might take years before another company decides to actually purchase them. Lastly, in regards to these categories, he wants to mention about the shifting around effect. Companies won't be in the same category forever. The story of the company might shift from a fast grower to a stalwart to a turnaround and so on. You need to keep checking up on your company's story and understand what's happening and whether or not you want to be investing in that company for the given situation. Even though it was a fast grow at the start, maybe you want to sell it because you aren't a fan of putting Stalwarts into your portfolio.